Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's just dive right in, take a look, and see what's going on. If you want to follow me, @Finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these topics, looking for investment opportunities and sharing them with everyone in the community. We do have a special going on. It is special. That's the coupon code that you want to use, and you can get savings in both the monthly membership and the yearly membership. It's 50% off the first month only on the monthly and a larger discount on the yearly membership. So coming back, we've got Diamond Energy announcing it is reducing its active rate, I believe it's active rig count by 3. So they are reducing their rig count. As prices of oil stay around this level, not just go down, but just stay and go sideways, we could see further reductions in rig count, and that can impact some of the energy service companies as they are providing services to these companies. Looking at Tavi. So Tavi says the chart below serves as a strong illustration of the kind of decade we may be heading into in his view. The historical cycle between U.S. and Latin American equities is well established. While investors often forget, leadership between these regions has historically rotated. Some years, the U.S. leads. The other years, Latin America takes the spotlight. We've just come through one of the longest stretches of U.S. outperformance relative to the Latin American markets on record. At some point, that cycle reverses. The potential peak of the U.S. dollar likely sets the stage for a notable shift in relative equity performance, in his opinion. It's also my opinion. I actually think that Latin American stocks are an excellent opportunity for investment. What he has here is the two where you could see Latin American investing outperformed in, say, the early 90s up into the late 90s. We had an underperformance from 98 to 2002 or so, and then a massive outperformance of Latin America stocks from 02 to 2008. From 2008, we've had a massively, really long bear market in Latin American stocks, and that deals with the value of the dollar. It's all based off currency exchange rates. Most of what's going on in the markets and most of the money flows that we see are based off of strong currencies or weak currencies, and the way that these currencies move against each other is what influences money flows. So if we see a weak dollar, if Trump is successful at what he wants to get, which is a weaker dollar, I would suspect that Latin American stocks will outperform the United States stock market. That would be my guess. And you can see the ratio here. It is way up there. This is the cheapest it's ever been over these past few months in relationship to U.S. equities. Paul says Plaquemines and Golden Pass LNG will add another 4 billion cubic feet per day of demand over the next 12 months. Total demand will surpass 114 billion cubic feet per day in 2026. Supply growing 8 to 10 billion cubic feet per day in a single year is unlikely under the best of conditions. He says an iceberg is dead ahead that we're ready to hit in natural gas. That also aligns with what some of the natural gas producers are showing in their presentations. That a large gap up in demand over the next, I'd say, year or two is going to be a tough thing to meet. Now, they don't say it's a tough thing to meet. They just tell you what the demand is out there of LNG capacity. I look at it like we need to get natural gas prices up and we need to get moving. We need to get the rig count going. We need to get drilling if we are going to feed natural gas into this LNG capacity. Spencer posts, Bespent sounding completely nervous on China, stuttering, saying it's not sustainable, saying he expects a deal, but clarifies the sides have not been talking. Wait. I thought they were talking, but he didn't want to disclose who was doing the talking. Now he's saying that the sides are not talking? I don't know. We'll see. Here's a coal ETF, Exchange Traded Concepts Trust Range Global Coal Index ETF. What I'm showing here is just a simple downtrend line break. Coal could be bottoming here and starting to move on up. They move very closely with the Newcastle coal futures. If it's thermal coal, if it's met coal, which I also think looks very enticing, and is squeezing into a corner. So met coal looks good. Thermal coal looks very similar to what we're looking at in this chart, a kind of a downtrend that's at support. And this downtrend line broke to the upside here. So we could see over the next few, let's say, weeks or months, potential bottom in coal and a move higher over time. And another thing, just to keep this out there, usually coal, natural gas, and even oil, they all move together. And it is weird that oil has diverged away from all of the other sectors that move with inflation. So I'll just say that because I do use some of these sectors like coal, like nat gas, like fertilizers, and some of these other ones that move with inflation. And oil is one of the most inflation sensitive assets. So kind of interesting of what's going on here in this divergence of oil versus everything else. Coming down, this is the long-term oil chart. I am still very bullish on the long term. I think that circle is where we're located. Now, have we done a complete bottom? Hard to say. But I think we're close. We're getting closer to this kind of washout sale. Sentiment gets completely buried to the downside, and then we reverse it and move on up at some point. Now, could we stay down for a little bit? Tough to say. Could we get a recession? Totally possible. This here was 9/11. This was a recession from 9/11. Maybe the recession is what we're in right now, and maybe it's not as bad as what people think. Maybe it could be worse than what people think. A lot of the times when you go through the recession, it's hard to know if you're in it, and it's difficult to know when it exactly ends until it's behind us. It's too late when it's behind us because then everybody's piled into these things, and then the prices move. Sometimes they move very rapidly because people get very bearish in this orange circle. They start to short oil because it broke a trend line, and then it reverses and all the shorts get squeezed. Now, I don't know if that will be the case. Maybe it won't, but we'll have to watch and see what the market does here. I'm bullish on oil on the long term here. I think this looks excellent, and nothing's been broken. So you get the three hump consolidations, you get the first wave, second wave pullback, you get a first wave, second wave pullback, and that's where I think we're located. So wave two pullback. Canadian Venture Exchange CDNX versus the price of gold GLD. Monthly stealth reversal after a false breakdown, in his opinion. Maybe about to sneak higher and finally break out versus the price of gold. It's bullish for gold, silver, copper, lithium, uranium, rare metals, and probably oil that he doesn't want to say here. So this is the CDNX potentially trying to break higher against gold. What happens? We go into a slowdown, fear in the market, it gets increased. Gold goes up. Gold has been going up since its bottom of September, October of 2022. The other markets go down and they go into a consolidation. We've been in a consolidation since 2022. It is completely the same as previous cycles where basically these assets go back and forth. Gold's getting its time in the sun right now. Silver will probably be next, and then oil and fertilizers and all the rest will come after these guys really start to run. So this is something to pay attention to, as we could potentially start to see an outperformance of some of these assets versus gold, which might mean that these other asset classes will start to outperform, and maybe the recession or slowdown is behind us. Now, obviously, we haven't broken that downtrend line yet. So that's not maybe necessarily the case yet, but it sure looks like it's trying to, with this big wick and hammer candlestick at the bottom there. Usually when you get these big wicks at the bottom and you get a big reversal candlestick, buyers are coming in there and buying it up. Tavi asks, very curious, what's the next 20% move in oil prices in your view? It's pretty evenly matched here. 50.9% say lower. I voted on higher from where we are today. That the next 20% move, 20% is a pretty big move. So I think we're going higher than lower. And if we don't go higher, I think we go sideways and consolidate. Part-time trader says oil is going to surprise everyone. And then this guy's saying, when is the catch-up between this break of the 30-year yield? You can use the 10-year too, and crude oil price. And this is something that I notice. I mean, I notice all these things, and I just find it really weird that we're seeing a big disconnect between oil and all of the other things that oil generally is correlated to. Yields is one of them. Usually, crude oil is the driver of the increase of yields. You can kind of see crude oil leads and yields follow. That's generally what occurs. Now, I think what is going on is that they're in the background, maybe they're trying to influence oil lower. Maybe that's why they put tariffs in, when they did. I don't know. And maybe they're trying to get the yields down to roll this debt over into lower yields, but it's not coming down. It doesn't believe the move, if that makes sense. So I don't know. Maybe that's one theory. Watch OPEC crude exports this month. It will tell you everything you need to know about how real this production increase is. Meanwhile, your spreads, your crack spreads, are still high. What does that mean? It means that your gasoline demand is still elevated and your oil price is low, so the spread between oil price and gasoline is big. You still have demand out there is what this is saying. Could that change? It could. Definitely could. But right now, it looks good. XOP divided by XLK monthly chart. This setup looks like the mirror of July of 2014. So XLK, I believe, is technology. And we've broken out of the downtrend in technology. We've come back on the retest. And we could be potentially breaking higher to the upside, where XOP, which is the energy ETF for exploration production, against the technology, could be moving up at some point in the future here. He says tight bands are expanding, new trend move developing. And again, tight bands are expanding. A new trend move is developing upwards. Multi-year consolidation before major uptrend begins and monthly MACD breaks above zero. So that's what he's got written, where we could see an outperformance of the energy sector over technology. This here is your cycle, if you want to know what the cycle is. So your cycle, your real estate cycle, is a big driver of this. Under a recovery phase of real estate, technology does very well. In an expansion phase, generally energy does well because it's a late cycle mover. Son of a Deshaun, oil down a lot, drill stops, data center and industrialization, electricity demand continues up. We do not have enough natural gas exposure. I would just say LNG terminals. You just need to see LNG terminals. LNG demand is going way up. Good luck with meeting it. Wind and solar are the cheapest sources of energy. Update. EU power grid needs trillion-dollar upgrade to avert Spain-style blackouts. It is definitely cheaper, right? Gold prices versus oil prices. Gold and oil pricing intersect regularly, though we now have a historic disconnection. What is more likely, the price of oil to rise or the price of gold to fall? I don't think the gold price is going to fall very much. I think oil is going to go higher. But that's me. And we've got this big disconnect between these two. There's oil down and gold's the blue line rocketing higher. That also means that we're in a certain market condition where there could be fear in the markets. That fear will cause these big disconnects between the two. People are not going to race to build manufacturing in America, Ken Griffin at Citadel has said of the tariffs. With the policy volatility, you actually undermine the very goal you're trying to achieve. We've got OPEC plus policy perception over reality. So OPEC plus crude exports tracking sideways. Not a very large increase in exports yet. I can obviously see that there's been news that's been released and people are positioning in tankers for that increase of oil shipping. But we haven't seen it hit the data yet in OPEC crude exports. One common characteristic of great investors, being frugal. Frugality. Geez, I haven't said frugality in like 800 years. My friend and accomplished investor Shelby Davis once told me about a study of great investors. It sought to identify the principles, qualities, educational backgrounds, training, demographics, or other characteristics linked to future investment performance. The study only found one common characteristic among great investors. They were all frugal. U.S. copper imports surged to a record high. Look at that move there in the IHS market copper import data. Boom. Ripping higher, way higher than anywhere else in history even back to the early 2000s. We got a pretty good amount even in the 2020s here. Look at how high that's been for copper imports. Here's Brady, silver versus gold, the SGR ratio. After calling the lows in real time back in 2020 for the stock market, commodity sectors, gold, uranium, etc., I continued posting a huge amount of charts showing that a big move was in the making back then. One of those charts was linked post and chart below showing the silver to gold ratio bottoming with a very bullish pattern. And now the chart also has a big spike to the downside and looks quite similar to back then. The big spike or down spike is clearly visible on the very big picture SGR chart below. A massive and strong reversal up for SGR is coming. Silver will soon take the lead, probably in the next weekly cycle. SGR has a cleaner pattern than GSR. When this ratio chart moves up, silver outperforms gold. Go time when blue pattern breaks out, now holding black support with bullish reversal. Intra-quarter looks like a final back test. We could be getting going here soon with silver, guys. So get ready. And the silver potential, very big move in silver. This is trading versus investing, and this is the differences. We've got Jesse Livermore. He's supposedly one of the better traders of all time. I think he went bankrupt 3 times. So trading is a short-term focus. It's a renter mindset, risk-seeking, looks for volatility, technical analysis, rapid buying and selling, profits from capital gains. Investing, it's a long-term focus. An owner mindset is risk-averse, looks for stability, fundamental analysis, buying and holding, profits from capital gains and dividends. is what the investing is. Now, I used to be more in the trading mindset, and now I'm more in the investing mindset. I'm playing the big moves, trying to capture the big moves in commodities here, and that's more of a long-term focused owner mindset. And I think it's a little bit less stressful, although you do ride through a lot of volatility. And that's what I've got for today, guys. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Use special as the coupon code. And we've got a midweek update that will be getting released probably for tomorrow. So that's also something you can look for on the website. All right, guys. We'll catch you next time. This is Finding Value.